Hey everyone, today's video I'm going to talk about how to invest in stocks during the recession. This will be a beginner's full course designed to provide all the needed information on how to start investing in the stock market as of right now. So let's talk about what you will learn in this video. You're going to learn exactly what is the stock market, stocks and how they make people money, classification of stocks, how to open a brokerage account, which account type is best, time in the market, the best way to do stock research, key terms, and the only way to make money. You will also learn how to deal with taxes, beginner's tax strategies to reduce your taxes, value versus momentum investments, Warren Buffett's essential principles of investing, how long should you hold stocks, why you should invest early, how much money should you invest, due diligence vs. FOMO, which means fear of missing out. And of course, I gotta bring some extra stuff. Stay tuned for this exciting new adventure. So, why you should invest in stocks as soon as possible? The number one reason is to make money. It offers growth over the long haul with strong and positive returns. When the recession hits, there will be a steady decline of stock prices. The average return on investments after the recession is over, there will be 2 to 3 times of what you originally put into the stock. Let your money work for you. The number 2 reason is money loses its value over time. For your money to make money, you need to grow it faster than inflation. Your dollar today is worth more than it will be in the future. Use the rule of 72 for investment returns. So basically, here's how it works. You divide 72 by the annual interest rate to determine the amount of time it takes for an investment to double. An example is a mutual fund that yields 2% a year will double in 36 years. One with a 6% annual return will do so in 12 years. Take a look at the S&P 500. It has grown since it started in July of 1982. It has been going up pretty consistent, and we do have a lot of correction within it, largely due to the pullbacks of the economy over time. The whole point of investing is putting your money to work, and it is growing for you long term. You may ask yourself, is this a good time to invest in this ETF when the market is crashing? I will point you back to this picture. The S&P has made a steady incline throughout the years, more incline than downward movements. So I think it is a good investment. Why you should invest in your retirement. So 64% goes into retirement. 56% should go into living comfortably. 53% should go into feeling financially secure. And 44% should go in maximizing my wealth. Despite this, 46% goes into people saying they aren't saving enough. It's the number one activity they say they need to do more of. 39% goes into expect to be forced to work beyond retirement age. And 12% goes into don't contribute to any retirement funds at all. This right here needs to be turned around. You need to have more people thinking about their retirements, vice more people thinking about they need to do more of thinking about their retirement. What exactly is the stock market? So, a stock market are venues where buyers and sellers meet to exchange shares in companies. Vital components of a free market economy. Access to trading and exchange of capital for investors of all kinds. They perform efficient price discovery and efficient dealing. Regulated by the SEC, otherwise known as Securities and Exchange Commission. Publicly traded company. Owners dilute their personal equity in exchange for capital. IPOs are also inside the stock market, which is initial public offering. Investment bank underwrite the IPO, buying up the shares, and they take risk. They sell these shares on the market for a fee. There are 13 different exchanges in the U.S. and allows individual investors to buy, sell in a regulated environment. A stock is defined as the proprietorship element in a corporation, usually divided into shares and represented by transferable certificates. You have a piece of a company, your shares of ownership in a corporation, a type of currency that is backed by that company. Units of stocks are called shares. Corporations issue stocks to raise funds to operate their businesses. So, Company A has 20% ownership and 20% profit. Let me talk more about the past history and what's going on forward. So, we had the biggest stock market crash in history back in 1929. Then came 1987, where we had another crash, which was known as the Black Monday crash. Then we had the dot-com bubble crash from 1999 to 2000. Now we're going into 2008, where we had the financial crisis crash. Then let's not forget the one that we're currently left like a year ago was the coronavirus crash back in 2020. I am predicting this year we will see another crash, which will be the stock market, crypto, and housing crash. How to protect yourself against stock market crashes. Number 1, don't give into the temptation to sell your stocks. Number 2, Keep a diversified portfolio of stocks, bonds, and commodity. Number 3, invest in gold. Classification of stocks. There are 3 types. First one is common stocks. Second one is preferred stock. And the third one, we're basically categorizing the stocks. Let's talk about common stock. It represents ownership in a company and a claim, otherwise known as dividend, on a portion of profits. Investors get 1 vote per share to elect the board members who oversees the major decision made by management. Now let's go on to preferred stock. It doesn't come with voting rights. It's more stable when it comes to dividend. You get paid on first in case of bankruptcy. It's harder to lose or gain value. Moving on to categorizing stocks. You got the small, mid, and large cap. The sectors range from tech, energy, auto, and etc. Based on location, growth versus value, ETFs, and mutual funds. Let's discuss the classification of stocks. You have a total of 5 classes. First one is growth, second one value, third is income, fourth is blue chip, and fifth is penny. Let's discuss more on growth stock. So a growth stock is usually new or fast-growing industries, and they have the potential to give shareholders greater returns. However, they are the most volatile class of stocks and may be just as likely to go down in price. Moving on to value stocks. Those are basically companies with growth potential that are currently selling at a low price relative to their intrinsic value. It can take time for their true value to be reflected by their price. Moving on to income stocks. Income stocks generally not expected to appreciate greatly in share price, but typically pay steady dividends. Utilities are examples of this right here, income stocks, where companies that have historically been considered income orientated. Moving on to blue chip stocks. Stocks of large, well-known companies with good reputation and strong records of profit growth. They are considered safe investments as they generally generate dividends. So expect money on top of that. Lastly is the penny stocks. Inexpensive, but they are risky stocks. Issued by companies with short or intrinsic performance histories. Their low price net a small loss in exchange for the potential of explosive growth. Let's go on to a stock by the name of Vanguard 500 Index Fund ETF, ticker symbol VOO. If you want to be safe and you're looking for a long-term growth stock, then consider investing in VOO. It's well diversified and comprised of equities of large U.S. corporations. They offer low fees because the fund's management team, they are not exactly trading, and instead they're just mirroring the S&P 500. Now let's talk about the types of brokerage accounts. You have the taxable account, which is the standard one. You pay taxes on any gains. Stocks, mutual, ETFs, and etc. fall up under this right here category. You have a cash versus margin account, and there are no limits. The retirement accounts, they're tax advantaged. Roth IRA, traditional IRA, SEP, solo, 401ks also fall up under it. They have a contribution limits, reduce the amount of taxes you're paying, and they have withdrawal rules. Many other accounts are HSA, 529 savings plan, custodial brokerage account, and robo-advisors. Opening up a standard brokerage account. This allows you to buy and sell stocks. Some of the brokerage you can go to are Robinhood, Webull, TD Ameritrade, Fidelity, Charles Schwab, and many others. For beginners, I recommend an app-based brokerage. They have free stocks for opening an account. There are no minimum account balance, easy to open, and you have to be 18 or over. So, what is the application process? How to create an account? You got to do several things. Submit an application. Provide your personal information like your SSN number, your address, your name, your date of birth, and etc. Set up a username and password. Verify your identity. Wait for your approval. Fund your account and start trading. I am now going to show you all the Robinhood screen on how to set up a trade and what to look for in the dashboard. So the first page I'm showing you is basically my overall screen for my Robinhood account. The first arrow is talking about the total amount that's in my account. Next one is what you gained or lost that day. The next arrow talks about the graph that shows your gain or losses. The next arrow says change your settings to either 1 day, weekly, monthly, and yearly. So if you're a day trader, you're more likely to keep your settings on 1 day. The last arrow says buying power. This basically means the cash that is in your account but is not actively invested into anything. Continuing on with my mobile app for Robinhood. You will see stocks that I currently have in my portfolio, as well as the watch list. It's basically things that I keep an eye out on, and I only use my target price. Once it comes to it, then I will think about investing into it based upon the current standard that is in right now. The next screen talks about the browser. It lets you know at the particular list of stocks that you're interested in, and it will show me everything in that category within the time period of viewing it. I can also view the news article, the current one. It informs me on what is going on in the economy and the stock market. Steps towards buying a stock on Robinhood. Step 1, go to the stock that you want to buy. And I'm choosing right now on the screen Microsoft. Step 2, click on the trade button. Step 3, click buy. Step 4, enter the number of shares. And if I enter 5 for total number of Microsoft buy, I'm going to buy for today. The market price is set at 260.89. And if I chose to buy 5 of those shares, it's going to put me on them $1,304.45. Step 5, click on shares to get the market and condition order settings. So the market order, it has different categories to look into as well as the condition orders. So the market orders, I can buy in dollars or I can buy in shares. Condition orders, I can do the following. I can set up recurring investment, do limit orders, trailing stop loss orders. I can do stop orders and stop limit orders. Limit order buy-in. So in order to find this right here, you got to go to the conditional order section and find limit order. This will allow you to set a maximum price that you want to buy a stock. I identified in 4 steps. Step 1, set the price. Step 2, the trading hours. Do you want to do market or extended? I usually do extended hours. Step 3, set time in force. Do you want to do it today's date or you want to do it 90 days later? Step 4, you want to do the number of shares you want to put into it, and it's going to tell you the limit price for that share, which you already said will be $100, and the estimated price is going to be $500 because you want to do 5 shares. Moving on to types of trades. There are 3 types: market order, limit order, and stop order. Market order is where you buy or sell at the best available price in the current market. The fastest way to buy or sell is the most basic type of buy and sell. Buy at the current asking price or sell at the bid price. Limit order, buy or sell at a specified price. You do the choosing on what you want to put the price at. Order only, execute if the stock hits that price. Meaning, if you want to put a price for $12, so if the stock hits $12, that's when the order is going to come on board. Stop order, buy or sell when the price moves past a specified price. How to research stocks. Important metrics to understand: price, cost to purchase 1 share of the company. You need context. 52-week low and high. The trading volume is the quantity of shares traded during a given period. Market capitalization, the total market value. Beta stocks volatility in relation to the overall market. P/E ratio, price per share or annual earning per share. Let's dive more into the PE ratio. So basically, you have a metric investors use to evaluate the stock. So the price is on top, which is the current stock price, divided by the earnings, with the earnings, aka profit per share, which equals the P/E ratio. So what does it show? It shows if a stock is cheap, fair price, or expensive. And how you will use it is to compare stocks and their industries. So you're going to look at the stock price today versus the competitor's stock price in the past. In other words, it's good to know the low P/E is usually better, but doesn't tell you everything. Such as Amazon, it has a high P/E ratio, but it's a great stock. So for the P/E ratio, you will have to do again the share price on top and the earnings per share on the bottom to get the P/E ratio. Example. So I have 200 for my share price and 10 for my earnings per share, and it would give me a PE ratio of 20. Let's talk now about the PEG ratio. The PEG ratio is the price/earning to growth ratio, is a valuation metric that goes beyond the traditional P/E ratio and considers a company's growth rate as well. So you're looking at PEG ratio is equal to the price/EPS over EPS growth. Or you can say PEG ratio is equal to P/E ratio over EPS growth. An example of a PEG ratio. Company 1, price is $10. EPS this year is $1. EPS 1 year ago is 66 cents. PE ratio is 10. Earnings growth rate is 1/0.66 minus 1, which is equal to 0.52, equal to 52%. So 10 over 52 is equal to 0.19, which is very low. How to research stocks. Important metrics to understand. Dividend yield. How much a company pays out in dividends each year compared to its stock price. Annual dividends per share/share price. It's expressed as a percentage. Price/book ratio. Stock price over book value per share. Tells us market valuation of a company. Is usually higher versus its book value. Book value is found from net asset of a company. Asset minus debt equals book value. Under 1 is good. Over 1 is overvalued. Continuing on with how to research stocks. Profit margin. Profit per dollar of revenue expressed as a percentage. 20% profit margin means each $1 of sale result in net income of 0.20 cents. Return on equity, ROE. Return on net asset measures financial performance of the company. The net income divided by shareholders' equity. 15% and up is considered good, but depends on the sector. Current ratio. Current assets divided by current liabilities. Measure short-term liquidity of a company. I would like to see it above 1. Does the company have enough cash to pay off debt in short term? So let's examine a stock together. So I decided to pick, as I stated earlier in my discussion, stock ticker symbol VOO, Vanguard 500 Index Fund. So it's currently sitting at $349.93 of my recording. That's the current stock price. And I'm looking at this summary tab. You can find all of this right here on Yahoo Finance. So the net asset is putting the company at $766.12 billion. The P/E ratio is putting the company at 4.07. The yield is putting the company at 1.45%. The beta is putting the company at 1.00, which is good. The 52-week range, it basically ranged between 334.24 through 441.26, and the current price is sitting at 349.93. So you're looking at a good return once when this recession is over to have a nice profit. The volume is sitting at 1,237,742. The average volume is also pretty high. Time in the market. So you may ask your question, should you do it or should you not do it since you are a new investor? In my heart, I'm telling you all, do not do it. But let's go ahead and dive into it. Definition. Trying to predict the stock market, meaning when it gains and when it crashes, and using other predictions to influence your buying and selling pattern. Historically, it has been better to buy after a crash than to try and time a market high. Stocks tend to recover. Must be a good company that will survive a crash or economic downturn. It's better to buy after a large crash, which is coming up pretty soon. Don't sell during small crashes, meaning don't panic sell. Focus on the long term. Hold as long as you can. Holding longer makes investing safer. Safe answer. Time in the market is bad, as I stated earlier. Rather spend more time in the market. What is dollar cost averaging? So basically what you're doing is you're taking the average price. You're going to invest equal amounts at a regular interval. And this will result in low stress. So basically, keys to success of dollar cost averaging is stick with the plan. No matter what the market does on a particular day or week. Never, ever go against your plan. Reason, to reduce risk and maximize returns over the long term. Continuing on with some dollar cost averaging. So, you have investment, stock price, shares purchased. In January, you invested $100 and the stock price was $9 and the share purchase was 11.1. In February, you invested $100. Stock price was now $10. The shares purchase was 10. In March, you invested $100 again. Stock price was now $11 and the shares purchase was 9.1. So you basically stayed with your same price each month. Regardless of what the stock price was, you stayed $100 each month. So the end result, you end up having 30.2 shares, and the average price paid was $9.93, even though each month it went up. That's why they say dollar cost average in. Let's talk now about appreciation versus dividends. We're going to first start with appreciation. Appreciation basically rise in share price due to a company performance and market sentiment. Sell higher than you bought to see a capital gain is not guaranteed. Now let's talk about dividend. Usually paid out quarterly. It's a recurring income. You can reinvest it or pull it out. Paid for company profit. Can I buy right before X dividend date? Yes, you can. Or no, you can't. You decide. Investigate. Many companies appreciate and pay out a dividend. So, how do you file your taxes when you invest in these stocks? Even if you sell one stock, you will be taxed and it will be more than you paid for it. So think long and hard before you sell on what it will cost you in the end. You have two types of gains: long-term gain and short-term gains. Let's talk about the long-term first. You will be taxed less due to you having the stock 1 year or longer. Depending on your income, it will range from 0, 15, or 20%. Now, the short term, you will be taxed more due to you having the stock less than 1 year. There is no income related to the tax. There is no income related to the tax amount. The best practice on investing is to keep them for 1 year plus. And your brokerage will send you a tax document each year with capital gains or losses. How to calculate capital gains. Capital gains are taxed and not the entire amount invested. Unlike the traditional income tax, only profit gets taxed. For example, an investment of $100,000 gets sold after a year for $105,000, which is a 5% gain. If the investor is single, the gain of $5,000 will be taxed at 15%, which is $750, leaving a take home of $104 plus. Calculating capital gains. $100K is the initial investment, 1 year. You sold it at $105K with a 5% gain, which equals to a short-term capital gain of $5,000 times 15% tax, which is $750, which leaves you with a take-home of $104K plus. Let's talk more about long-term capital gain. The filing status, percent ratio, 15 and 20%. So if you are single, the rate for 0% is up to $40K plus. 15% rate is $40K plus to $445K plus. The 20% rate is over $445K plus. If you are married filing jointly, the percent rate is up to $80K plus. The 15% rate is from $80K plus to $501K plus. At 20% rate is over $501K plus. If you are married and filing separately, the 0% ratio is up to $40K plus. 15% is $40K through $250K plus. 20% rate is over $250K plus. If you are the head of the household, it's up to $54K plus for 0% rate. 15% rate is $54K through $473K plus. 20% rate is over $473K plus. Moving on to short-term capital gains. You got the rate, the single, married, filing jointly, married, filing separately, and head of household. I'm only going to go through the 10% through the 22%. So for single, it's going to be for the 10%, 0 through 10,000 plus. For married, it's going to be 0 through 20K plus. That is married filing jointly. Married filing separately, it's going to be 0 through 10K plus. Head of household is 0 through 14K plus. 12% single, 10K through 41K plus. Married filing jointly, 20K through 83K plus. Married filing separately, 10K through 41K plus. Head of household, 14K through 55K plus. 22% single, 41K through 89K plus. Married filing jointly, 83K through 178K plus. Married filing separately, 41K through 89K plus. Head of household, 55K through 89K plus. Let's talk now about the retirement accounts overview. Save big on taxes. Everyone should take advantage of tax advantage retirement accounts. Roth IRA if you are eligible. Pay taxes now and avoid taxes on any gains. Pull-out gains in retirement is 59 and a half years old. Compare this to a normal taxable account, which is taxed twice. Contribute up to $6,000 per year. The Wealth Fort is a great option. Other retirement accounts that you can reserve yourself. Roth IRA are not the only option. There's also 401k for people that works with companies, and traditional IRA. Tax loss harvesting allows you to sell investments that are down, replace them with reasonably similar investment, and then offset realized investment gains for those losses. The end result is that less of your money goes to taxes and more may stay invested and working for you. With tax loss harvesting, you have the following example. So John sells all of his Tesla stocks. He claims the $300 of loss on his tax return. He now only pays taxes on $200 of the capital gain. So he had $500 minus $300 equals $200. Let's talk now about momentum investing versus value investing. Should you buy high, sell higher, or buy low, sell high? Let's discuss. Value investing. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Value investors actively hunt for stocks they think the stock market is underestimating. In simple words, buy low, sell high. Benjamin Graham, an American economist, investor, and professor, pioneered a new method of investing in stocks known as value investing in the 1920s. He is known as the father of value investing, and his methods are used by investors till this day, with notable followers such as Warren Buffett and Peter Lynch. The principle behind value investing is purchase stocks when they are undervalued or on sale, and sell them when they reach their true or intrinsic value or rise above it. Another condition which value investors follow is allowing for a margin of safety when trading in value investing stocks. Now, with any investments, there's always risk and advantages. So let's talk about the risk of value investing. The main disadvantage of value investing is that it is often rewarded in longer time frames, and investors may not get returns in shorter time frames. Also, it is highly time consuming to shortlist such undervalued companies for investment. The advantages: it is a low risk strategy if done properly, and gives Substantial returns. The core portfolio of an investor should be formed with this strategy. As the companies are having strong fundamental, it provides stability to a portfolio. Momentum investing. Momentum investing is buying stocks/securities that are going up, making higher highs, because as the trend goes, rising stocks keep going up for a certain time frame and falling stocks keep falling for a certain time frame. This is based on technical analysis. Momentum investors apply TA indicators such as trend lines, RSI, and etc. to the analysis of a security in order to identify trends and gauge the strength of that trend. In other words, to determine the level of price momentum in the market. The method is further classified on the basis of benchmarks. Relative momentum in this strategy before investing, investors compare the performance of stocks to each other, and they shortlist the stocks which have outperformed compared to others in the recent past. Investors will invest in these stocks hoping that they will give similar returns over next few months. Absolute momentum. Investors will compare the performance of a stock to its own historical performance. If they find a stock with positive performing stocks, then they invest into it, and they avoid negative performing stocks. The risk and rewards of momentum investing. Risk. One needs to be very actively churning the portfolio to lock the profits. Also, investors need to keep stop losses to their positions and identify the trend reversal at the right time. It should not be more than 15 to 20% of the portfolio. Advantages. Investors is rewarded with a very high return. It forms the satellite part of the investor portfolio, which creates alpha to his portfolio returns. Let's talk about Buffett's principles of investing. Leaders are important. Invest with facts, not emotion. Invest for the long term. Don't sell unless the business changes fundamentally in the bad way. For 95% of people, an index fund is best. Buy what you know. When you see a great opportunity, take it. Let's talk now about the importance of investing early. Investments can increase in value over the years, and generally, the earlier you invest, the more time your investments has to grow. One important advantage that young people have is time. They usually have more time to allow an investment to increase in value than older people. So, it's never too early to invest. I am going to dive in a little deeper upon early investment. There are more recovery time. If you invest early and incur a loss, you have more time to make up for the loss on investments. Whereas an investor who starts investing at a later stage in life will get less time to recover his or her losses. Thus, with early investment, your investment get more time to grow in value. You save more. With early age investment, you develop a habit of saving more. The more you invest, the more you get in further. To follow that process, you tend to save more by cutting on unnecessary expenses and divert such saved money towards investment. Improves risk taking ability. Studies show that young investors have more risk taking ability than older ones. Adult investors are generally conservative and prefer stability, in turn, avoiding high risk investment avenues. There is an old saying, more the risk, more is the reward. The probability of earning handsome returns at a young age get enhanced with high risk taking ability. Time value of money. Early investment leads to compounding returns. The time value of money increases over a period of time. Regular investment made right from an early age can reap huge benefits at the time of the retirement. Moreover, early investment facilitates your entry in the world of finance early. Your money grows with time. Because of early investment, you can afford things which others might not at that age. This puts you ahead of others who prefer investing at a later stage in life. Secured future. There will be time in life when you will need urgent money to meet unavoidable expenses. During such times, the investment made at an early age can prove to be very handy and will help you get through the tough times all by yourself. The need for borrowing money from others decreases drastically with early investment. Become a creditor. An early age investment is indeed useful. When you have surplus money invested, you will never have a need to borrow money and become someone else's debtor. With money parked in the right investment avenue at the right age, you have money to lend to others, i.e., you become the creditor. Support your retirement plans. Early age investments increase the probability of reaching financial stability at a young age. Saving for retirement from the age of 20s rather than the age of 40s is always a better idea. Life after retirement is more challenging than it has ever been. So planning for retirement now will lead to happier life after retirement. Let's look at this diagram of Isabella and Aki. So the benefits of investing earlier. Isabella, she starts at age 20. Aki, he starts at age 30. Isabella has a 7% a year for 45 years in a row. Aki, he has a 75% a year for 35 years in a row. So at age 20, Isabella money grew to $345K, whereas Aki at age 30, when he started investing, his money grew to $175K. So there's a benefit towards investing early because you get a head start on how the market moves and you understand a lot better. You can get in and out of plays. You may ask yourself, how much should you invest? Invest the money you don't need to live on. That is why raising your income is very important. The rich get richer. If you're young and have excess cash, open up an account after watching this video. Invest to get the ball rolling. However, probably better things to invest in with higher ROI. Self-improvement, building a business, education. Those are a few. Get over the initial hump of starting an investment. Set a monthly goal of how much money to invest based on your income. Prioritize index funds. Let's talk about now DD, otherwise known as due diligence. Due diligence is defined as an investigation of a potential investment, such as a stock or product, to confirm all facts. These facts can include such things as reviewing all financial records, the past company performance, plus anything else deemed material. So, doing DD. Reading other people's DD posts, skimming through DD posts, and instead reading the comments to see if it's a good pick or not. All right, so get started now to receive financial freedom. Open up a stock brokerage account. Go back through my video to help you out if needed. Fund your account. Do DD, otherwise known as due diligence, on all your investments. Don't take anyone's word on it, nor do FOMO buying, which is known as fear of missing out. Buy your first stock. Continue to learn about stocks and how the market works. You can come to my channel to gain more insight anytime. Happy trading. Please like and subscribe for more videos like this. And don't forget to share.